Welcome to The Explainer. Today, we're going to demystify the, let's face it, pretty confusing world of landlord taxes. And the best way to do that is with a real, hands-on case study.
So how does rental income really get taxed? It's way more than just taking your rent and subtracting your expenses. We're going to follow a landlord through a super busy year, buying, selling, renovating, and see exactly how it all shakes out on their tax bill. Here's how we'll break it down. We'll start with the landlord's properties, walk through the key tax rules, see what happens when they buy and sell, and then tie it all together with the most important lessons for you.
All right, let's get into it. First up, the puzzle. Let's meet our landlord and take a look at their portfolio. There are 4 properties here, and trust me, each one has its own little adventure this tax year.
Okay, so here's a snapshot of the portfolio. You can see we've got 4 properties in play. One is getting some major upgrades, another is brand new, and this is important, 2 are being sold this year. The columns you really want to watch are the opening UCC, that's just the taxman's term for the property's book value, and that last column, which shows the basic income or loss each one brought in before we do any of the fancy tax math.
All right, before we start crunching any numbers, we have to talk about the 2 golden rules. Seriously, these 2 regulations are the foundation for everything that follows. You got to know these.
So, rule number 1. You can't use depreciation, or what the tax folks call Capital Cost Allowance, CCA, to create or increase a rental loss. You just can't. Rule number 2. Every rental property you own that costs more than 50 grand has to be put in its own separate class. Think of each property as its own little tax island. This is going to be so important when we get to the part about selling.
Okay, rules are set. Let's move on to the fun part, tracking the new stuff. We're going to look at what happens when our landlord buys a new property and makes some big improvements.
So, 2 big moves this year. They bought a whole new property on Hart Street. We're talking over $1 million, and they also poured a good chunk of change into renovating the place on Mark Avenue. For tax purposes, both of these are called additions.
Now this is where it gets really interesting. The government has this thing called the Accelerated Investment Incentive, or AII. What does that mean? Well, in simple terms, in the very first year you own something new, you get to calculate your depreciation as if it cost 50% more than it actually did. It's a huge boost that can create a much bigger potential tax deduction right off the bat.
And check out what that incentive does. It creates this massive potential CCA claim, over 40 grand for each of those properties. So on paper, it looks like our landlord is about to get a giant write-off. But I want you to notice I keep saying potential. Because as we're about to find out whether you can actually use that full deduction, well, that's a whole other question.
All right, so that's the buys and improvements side. Now let's switch gears and look at the sells. The landlord sold 2 properties, and you're about to see how they lead to 2 completely different tax situations. First, let's talk recapture. The easiest way to think about this is the taxman taking back the depreciation you claimed over the years. You've been writing down the value of your building, right? Well, if you sell it for more than that written down value, the government says, hey, wait a minute, and they recapture that difference and add it straight back to your income.
And on the flip side, you have a terminal loss. This is the exact opposite. It happens when you sell a property for less than its tax value. It's basically a final, fully deductible loss for all that depreciation you never got to claim.
Okay, look at this side by side. This is where it all comes together. On the left, we have the Flagler Street property, sold for a profit. This triggers 2 things. First, that big recapture we just talked about, which gets added to their income. But on top of that, there's a separate taxable capital gain. 2 hits. Now look at the right side, Barton Boulevard. It's sold for a loss. So the landlord gets that terminal loss, which is great. They can deduct that. But, and this is a tough pill to swallow for a lot of investors, you are not allowed to claim a capital loss on a building like this. That part of the loss, it just vanishes. You can't use it. And hey, don't forget the small stuff. The landlord also got rid of a bunch of old furniture. They gave it away so the sale price was 0. And guess what? That created another little terminal loss that's fully deductible. Every little bit counts.
Okay, we've looked at the buys, we've looked at the sells, we have all the pieces of the puzzle. Now it's time to put them all together and figure out the final tax bill.
So, where do we start? We start with the simple number, $33,783. This is just the total operating income from all the properties combined before we factor in any of that recapture, terminal loss, or CCA stuff.
Okay,
So we take that starting income. First, we have to add back that big $55,000 recapture from the property we sold. Then we get to subtract our two terminal losses, the one from the building and the smaller one from the furniture. You do all that math and you're left with $49,235. This is the magic number.
And now, remember golden rule number 1? The one that says you cannot use CCA to create or increase a rental loss? Well, it's about to come into play, big time. Remember those huge potential CCA claims we calculated earlier? The ones that were over 40 grand each?
Well, here's the punchline. Even though our landlord has this massive potential CCA deduction available, they can only use exactly $49,235 of it. Why? Because that's the exact amount of income they have left. They can claim just enough to bring their net rental income down to zero. Not a penny less, and definitely not a penny more. All that extra potential deduction, it gets carried forward to fight another day in a future tax year.
So, after all that, what's the bottom line? What are the big takeaways for any landlord or real estate investor watching this?
Okay, let's break it down. First, selling a property is not one single tax event. It's a bunch of them all at once. You've got recapture, terminal loss, and capital gains, and they are all calculated differently. Second, CCA is an amazing tool, but it has a hard limit. You can't use it to create a loss. Your goal is to get to zero, not below it. Also, don't forget that capital gains are a totally separate calculation from your rental income. And finally, never ever forget that painful rule. Capital losses on depreciable properties like buildings, they're denied, gone.
So, knowing all this, think about it. How might this change the way you structure your next purchase or sale? This whole exercise shows that understanding the tax rules isn't just about being compliant. It's about being strategic. It's what separates a passive property owner from a truly savvy, successful investor.